All right, welcome to the Do You Qualify for HARP 2.0 webinar. We're very thankful to have you on the call, and we're just going to wait a couple more seconds for everyone else to get on the call, so please be patient, and we'll be started in just a second. Okay. So my name is Jason Drzeski. I'm the co-host of Call Tony Real Estate Radio, which I'm sure a lot of you heard about this webinar on our radio show or through one of our websites. And we're very fortunate to have Michael DeVita and Mark Latini of DeVita Home Finance on the show today, or on the webinar today, actually, because we want to expand and talk about this HARP 2.0 program, the Home Affordable Refinance Program. So, Mike and Mark, are you on the call there?
Yes, we are, Jason.
Great.
Hey, Jason.
Hey, guys. So I really appreciate you taking some time. I know you're extremely busy, especially with this program among your other clients that you're helping. But this HARP 2.0 program has been something we really needed in this space, because a lot of people are going to try to do a loan modification, or they're trying to find some way to refinance, and there hasn't really been a lot of options for them prior to this program really starting to loosen its guidelines to be able to help people. Is that right?
That's absolutely correct. It's a fantastic alternative to really no options people had before.
Right. So let's talk about what we're going to cover today. Number one, we're going to talk about what is HARP 2.0, the Home Affordable Refinance Program, the main requirements, the common mistakes that homeowners make when you're applying for it, a success story, as well as how to see if you qualify, and also what options you have if you don't qualify, because there may be some other ways that you can get help that may not fit into this program. But I do want to tell you, before we get any further, there's a chat box here on the screen, so any questions you have throughout this webinar, feel free to chat in the box. We may not get to them on the call. We're going to cover a lot of the questions you have on this call, but definitely put your chat questions in the box, and we'll get to as many as we can. So, guys, you were recently on our radio show and talked about this HARP 2.0 program, which stands for, again, the Home Affordable Refinance Program. Mike, I'll start with you. Why don't you tell me what HARP is and kind of where it started and where we've gotten to now?
Yeah, no problem. So just with the climate of real estate for the last 5 years, with values dropping significantly, in 2009, the government was trying to implement a loan program which would allow people to refinance even if they've lost more equity, so that they were basically underwater. So what that means is their loan was actually more than the value of the property. Mm-hmm. Traditionally, you can only refinance your mortgage when you have equity, when you at least have 100% loan to value or less. So the original program, which came out in 2009, it essentially allowed people to refinance up to 125% of the value of the property. Now, that was great in theory, except there were so many people that were above that ratio. They just didn't qualify. They lost more value than that. So the amended version of this loan program, which came out this last April, the gist of it is, and the main part of it in terms of qualifying is it's unlimited loan to value. So it doesn't matter what the appraised value of the property is. If you qualify for the program, you can actually refinance the house.
So, yeah, I mean, a lot of people, they were looking at situations that they were current on their mortgage and they wanted to try to get a loan modification, but their bank said, well, you have to be behind on your mortgage to get qualified for this loan modification. And people wanted to do the right thing and stay current on their mortgage. So then they'd go to their retail bank and they'd say, well, we want to refinance. And when they found out that their house was significantly underwater, meaning they owed more on it than it's currently worth, they kind of left themselves with a situation where they couldn't get any help until this program came into place. And now you're saying that it's unlimited loan to value, meaning that it doesn't matter what the house is currently worth?
Correct. And let me explain. There's loan to value and there's cumulative loan to value, which you see up on the screen right now. So the loan to value is the main loan, so your first mortgage divided by the value. So once again, it doesn't matter what the value is. Now, cumulative loan to value means if you have a second mortgage. So you could refinance your first mortgage. It doesn't matter what the value is. And you can even, the term is called a subordination. You can keep your second mortgage. It will go behind this new mortgage that you can refinance.
So a lot of people, and I'll bring Mark Latini on, a lot of people took out second mortgages. They took out home equity lines of credit, and they probably on the home equity lines have a pretty good interest rate, I'm guessing, right now, depending on what type of loan they have. So, Mark, is that a good situation where maybe the second lien would let them keep that low interest rate and keep that second mortgage in place and then be able to refinance the first mortgage into this HARP refinance program?
Yeah, it's definitely a good situation. Currently, one thing they've got to keep in mind is in the long run, the rates are eventually going to go up on those equity lines as well.
Right.
But the good thing about it is that what we've seen is the second lien holders have been they've been approving to stay in second position like they should and like the government wants them to. So it's actually allowing for the refinance to be done in the first loan.
Okay. And talk about, Mark, the credit score. It says no minimum credit score here on the screen. What, are they just not pulling your credit report at all, or they're just not putting any weight on what someone's credit score is?
Right. They are pulling credit reports, and what happens is all the loans that are being sold to Fannie Mae and Freddie Mac have to go through an automated underwriting system. So what happens is we run the credit report, it merges it with the application, and then it runs it through their system, and then it will spit out basically an approval. And with this program, they've modified their underwriting system to where it's supposed to not care really what your credit score is. I'm not saying if you have, 400 credit score that it's going to approve your loan. It may or may not, because there's some factors that would get your credit to that level. But it's not taking into account saying, hey, there's a minimum credit score of 680 or 640. You can have a 600 score and still do this. So that's not a huge factor anymore.
Okay. And then, Mike DeVita, you said when we were speaking earlier that it doesn't really matter what type of property it is, meaning the occupancy of it, meaning it can be the house you're living in or an investment property, right?
Correct. It can be your owner-occupied home. It could be a second home. It could be an investment property. Also, occupancy type, how many units you have. So it can be, 1 unit up to 4 units. The occupancy type can actually have changed during that time frame. So it could be a house that you bought, you lived in, at one point, and now it's an investment property, and we're refinancing it as an investment property. So that's fine as well.
Okay. And then it also says the unlimited amount of properties. I know with some refinance programs and people that have purchased several properties and now they're kind of sitting and they have them all underwater and don't know what to do. This may work for quite a few of those properties, or at least it doesn't matter if they own several properties. Is that right?
Correct. That mainly affects things when it's a non-owner property, because most lenders don't care if you're refinancing your primary residence, how many other properties you own. But a lot of them have an issue if you own if you have more than 4 financed residential properties. They usually don't want to finance the 5th, which Fannie Mae says they should allow, and on this program they're allowing it.
Got it. Now, at the first part of this slide said unlimited loan to value, so we already got that they're going to allow this refinance program for people that, regardless of how much they owe on it. But there's also something that says appraisal waiver. So, Mark, you were mentioning that that's a really good cost savings for people when they're trying to do the refinance because they may not have to pay for the appraisal.
Yeah, that's correct. It definitely cuts out some of the costs because when we run these through, like I was saying with that automated system, it will tell you if you need an appraisal or not. The majority of them are not requiring appraisals, even when they're completely upside down and owe more than what the properties were. So that will save them, probably depending on the property, it could be $400. If it's a multi-unit property, it could be up to $650.
Got it. Okay. And then the other main requirement for this particular refinance program is that it has to be owned by Fannie Mae or Freddie Mac as the investor, which some people don't know, and some people know definitely that it's owned by one of these two entities. If you don't know if Fannie Mae or Freddie Mac is the investor that has your loan, then just put your email address in the chat box below, and we'll reply to you with all the links and phone numbers and everything that you need so that you can check on that. And you can also definitely give us a call. We'll give the phone number in just a moment. Mike, I want to talk about just a couple common mistakes because you were on our radio show a couple days ago, actually pretty recently, and you mentioned a few things that people were doing that were making them feel like they didn't qualify for this HARP refinance, but then they ended up turning around and calling you and come to find out they did. So tell us a little bit about people checking with their own lender and what experiences you've been hearing.
Well, what happens is, a lot of the major retail banks, say like a Wells Fargo, Bank of America, or Chase, they have, even though this program is supposed to offer unlimited loan to value, once again, it doesn't matter what the home appraises for, a lot of big banks have what they call overlays on this product. And what that means is, they basically decided that they're not comfortable with the program guidelines. So they might say, we don't want to do unlimited loan to value. So they might go back to the original, HARP guideline of saying 125% is their max. And it's understandable why they would do that because they don't want to take on extra risk of lending money to somebody who's so far underwater that they're, a high risk of default. So, a lot of people call the bank. They're told that they don't qualify, but they're not told that maybe they would qualify with another lender. So we've had some people call us pretty much thinking that they weren't eligible for the program, and we were able to take them to a bank that was able to do the loans.
Wow.
I just had this situation with a client that he has several mortgages, and one was with Chase. So he called Chase to refinance that, and they told him, sure, we can do that. And then they looked at the other mortgages and said, no, you can't refinance those. And luckily, he's been a client of mine for a long time. He called me, and I looked at it, and it's backed by Fannie Mae. I just ran it through the system. The value is going to come in fine. It gave me a pre-approval already, so they just didn't want to touch it. So
sure.
They're okay with refinancing their loan if they're holding a note already, because it reduces their risk. But
right.
His other properties they don't even want to help him with, so it's very frustrating.
So it's really key in this situation, if you're listening now, to explore your options, especially with DaVita Home Finance, because like they said, you may call your current lender, if it's a Bank of America, Wells Fargo, Chase, or whoever it is, and they may not be participating in this particular program or have such strict overlays and guidelines that they'll tell you that you don't qualify, but then come to find out, because of the relationships that DaVita Home Finance has, they can run you through a few different scenarios in different banks and try to find you a lender that will actually work with you. And Mike, you were talking on our show the other day about the number of relationships you have with different banks. How many is that number up to now?
We're well over 40 right now.
So you have 40 different opportunities that people can qualify with different banks, because you've been in the industry for a long time and you've developed these relationships where you can bring these loans to the other banks and try to fit people into the box that makes sense for them.
Correct. We're working with the big banks too. We're doing loans through Wells Fargo and GMAC and Citibank, but not all scenarios fit within their guidelines. So we have to find alternatives for people, and that's why we have so many banks. If we find a lender that's willing to do something that's a little bit different that can help people, that's why we get approved to do business with them.
Like Mike was saying, we work with the larger lenders like Wells Fargo and Citibank, and they're very helpful on their own loans. But when it comes to a loan that's not on their books now, they put more restrictions on the loan to values and things like that.
Okay. And then, Mike, you also mentioned that you wanted to bring up people aren't taking the extra step of verifying that Fannie Mae or Freddie Mac is their investor on their loan.
Correct. And so there's a couple ways to do this. One is to go to the Fannie Mae or Freddie Mac websites, and you can simply input your address, and the websites will tell you whether or not you are a Fannie Mae or Freddie Mac loan. Here's the problem. The website isn't perfect. So if you make a mistake inputting your address, there's a good chance that it's going to say it doesn't recognize your loan as Fannie Mae or Freddie Mac. Another thing is whether or not how your address was written. Was it written out with Avenue all written out, or was it AVE? Or another problem we've seen is maybe you live in a city where there's so many different areas, say like Los Angeles, where there's certain areas where you can consider it Los Angeles or also Santa Monica. It's still in Los Angeles. There's different names in different cities, so a lot of times zip codes come up as different names if there's a lot of different variations in their city. So the good thing is if you went to the website and you were disappointed because it said you didn't have a Fannie Mae loan, we want to encourage you to call us. We'll give you the numbers for Fannie Mae and Freddie Mac, and give them a call. It takes a few minutes and just ask them. And then they can do a little research on their end. So
you can put your information, your email address into the chat box now, say that you want the links for Fannie Mae and Freddie Mac, or you can call us at 888-309-9797. We'll have that number up at the end of this webinar, which is coming up shortly. And either way, we'll put you in with the correct information so you can call Fannie Mae and Freddie Mac to make sure that they're either one of your investors or they're not. So I really wanted to talk about a success story, because it's easy to say, oh, you can refinance with this new program, it's amazing, but if you don't put this into real figures, then it doesn't really make a lot of sense to some people. So this is a scenario that I thought was phenomenal. There was a client, Mike, that you had that bought the house for $400,000 and they put 20% down, so it made them owe $320,000. They had a 6.5% interest rate, and they were paying $2,022 a month. So tell us from there what happened now 5 years later when they are looking to refinance and they owe more than it's currently worth.
This is an old client of mine. They gave me a call. Over the last 5 years, they paid down their loan. Just making the regular payments. They paid on time, and in 5 years they owed $299,000. Now the problem had been that the house, that they bought for $400,000 was only worth $175,000.
Right.
So that's a big hit. That's pretty discouraging for people. So over that time frame, with that drastic loss in value, they never had an option to refinance their mortgage ever. And over the last 5 years, rates have dropped to historical lows. Right now we're at 60-year lows in terms of interest rates. So we were able to refinance that loan for $299,000. We got them an interest rate on a new 30-year fixed at 4.375. They had a Fannie Mae loan. We ran it through Fannie Mae. It gave us an appraisal waiver, so no appraisal. And we're funding the loan, and we funded the loan, and the new payment is $1,492 a month. So it's a $530 savings, and which is great. Is the client didn't have to put any money up front. They didn't have to pay for the appraisal. We closed their deal, and they couldn't be happier.
What I think is most phenomenal about this is this same client is doing the right thing. They're trying to keep up with their mortgage payments, and just needed a break on the payment. And they were current, but I'm sure that if they went and tried to do a loan modification, the bank would have said, well, you're current and you're paying us on time. There's no way to really lower your payment. And looking at this new refinance program, it's the thing about this HARP refinance program is it's not new, but the guidelines have just been relaxed now to make more sense for people to qualify. So had they gone to their bank and just tried to do a loan modification, probably wouldn't have gotten the same result. But now, since they work with you guys at DeVito Home Finance, they were able to drop the payment $530 a month and stay current on the mortgage.
That's what's really important about this scenario is that in March, this client would not have qualified on the old HARP guidelines. So if they had gone to their bank even a couple months back and tried to do this, they would have told them, no, you can't refinance it. It's just been opened up to those high loan to values like that.
Right. So here's how to see if you qualify, guys. Either A, put your information, your email address into the chat box and hit submit, and we'll get back to you sometime in the next 24 hours to see if you qualify. Or the fastest approach is call us right now at 888-309-9797. If you get a recording, just leave your name and your phone number, and somebody from DeVito Home Finance will call you right back and run you through the system and see if you qualify. So that's 888-309-9797. Now, before we end this call, I see a lot of questions coming in, but I know we're running out of time here, so we will get back to you guys later in the week. But if you don't qualify, I know, Mark, you talk a lot about the different programs that people may qualify for if HARP isn't one of them. Can you tell us a little bit about the FHA and VA streamlined programs and anything else you see that people may fit into?
Sure. I actually prefer the FHA and VA streamlines to the HARP program, and these have been around as long as I can remember. And pretty much all the banks are doing these. So some of them do require different things than others, but basically the streamline will allow you to refinance without an appraisal as well if you have an FHA or a VA loan. And what's even better than HARP is that they don't actually require you to qualify income-wise. So all you have to do is basically submit. As long as you've been paying your payments on time, you should be able to qualify for these programs and drop your rate.
Okay. And the FHA and VA, that's who, just like Fannie Mae and Freddie Mac would be an investor, FHA or the Veterans Administration would be the investor on those types of loans to help them refinance. Is that right?
Correct.
Okay.
They're just government-backed loans.
Got it. And the good news is for everyone out there listening is Fannie Mae, Freddie Mac, FHA, and VA, if you encompass all of those together, it makes up probably a majority of the loans out there. So there's a high probability that you qualify for one of these programs. Would you guys agree on the phone?
I would agree. I mean, there's a large portion of people out there have one of these loans. Absolutely. Okay. Anything else would be like a jumbo loan or kind of a one-off scenario. There are some different loans out there, but the majority are conventional FHA, VA.
Right. So awesome, guys. Well, go ahead, Mark.
I was going to say one of the areas we have seen trouble in are the option arm loans that people had.
Right.
And unfortunately, those are not backed by Fannie Mae or Freddie Mac, and normally those are like private money from the banks. But as of now, I haven't seen really a program that will help those. But we do hear certain things that there's supposed to be help for all types of loans, even some of the jumbo stuff that's out there now.
Yeah, you know what? I encourage you, regardless of the type of loan, even if you have those negative amortization or pick-a-pay loans, to call in, because even if there's not a program available today, I know these guidelines are changing like crazy, and we can put you into our database to be the first ones we notify once we find out about programs for those loans as well. So give us a call again at 888-309-9797. We'll put you right in touch with DeVita Home Finance and see what you qualify for. And if you've been turned down by your current bank, if you've been turned down for a loan modification and you really don't know what to do, we may be able to find a program for you through all the relationships that DeVita Home Finance has to get you to a position where your payment is lower and you're able to start fresh and move on.
Yeah, that's a great point, because these programs are continually changing. So if we have you in our database, then as soon as there are changes that may help you, then Jason can get in contact with you and let you know.
Sure. And Mike, any parting words from you? I know we're running up to the end of this. We wanted to keep it short so that people could move on about their day, but I really appreciate you being on the webinar here. Any last words you want to leave with the audience here?
Well, I just wanted to thank you and Tony, Jason, for having us on the show and allowing us this opportunity to get our company out there, and more importantly, it's to help people. We're here to really help educate people, and we want to talk to people, even if they think there's no hope. We're here. Give us a call anytime, and we're willing to talk. Walk you through all the options you have, and hopefully find something that will help you. So that's it. Mark, anything you want to say?
No, thanks a lot for having us.
All right, thanks, guys. So, again, call the number 888-309-9797 or enter your email into the chat box, and we'll get back within the next 24 hours to see what you qualify for. And other than that, I appreciate you being on the call and wish you the best of luck. Thank you very much.